Welcome to RBC's Markets in Motion podcast, recorded February 10th, 2025. I'm Lori Calvasina, head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. The big things you need to know. First, the earnings backdrop has softened a bit on the stats for the broader market and has also justified the rotation in performance leadership that's been seen. Second, company commentary in last week's earnings calls highlighted the uncertain optimism driving U.S. equity market performance. And third, weakness in investor sentiment and a miss on consumer sentiment stand out in our high-frequency updates from last week. We continue to closely monitor the vibes, whose anticipated strength has been an important part of the bullish thesis on the U.S. equity market for 2025. If you'd like to hear more, here's another 6 minutes. Let's start with takeaway number one, the earnings backdrop. It remains solid, but it has softened a bit, and what we're seeing on revisions also justifies the rotation in performance leadership that's been seen. The stocks that have reported have behaved logically, with earnings beats outperforming in terms of immediate price action, while misses are lagging. We do think earnings has been the big driver of the market in recent weeks. There has been some softening in the aggregate, however. The rate of upward EPS estimate revisions for the S&P 500 has deteriorated as reporting season has progressed and now stands at just 40% upward revisions. In dollar terms, the bottom-up consensus now anticipates 2025 S&P EPS to come in a little below 272, down from the 273 level that had been in place for a while. On guidance, we haven't seen a big spike in downward guidance, which is what we saw a year ago. Last year, the S&P seemed to benefit from an effort by companies to keep sell-side and investor expectations low, and as a result, earnings forecasts for 2024 were pretty stable throughout the year. But we just don't have this same setup for 2025. On positioning, the rotation in leadership within large cap and stabilization of small versus large that's occurred in terms of performance does make sense in the context of what we're seeing in terms of earnings revision trends or earnings sentiment. The rate of upward EPS estimate revisions to analyst forecasts has been better in small cap than large cap. Small cap is just getting more upward revisions right now. Meanwhile, if we look within large cap, the top 10 market cap names and growth stocks are still tracking better than the rest of the market and value stocks on the rate of upward revisions, but the top 10 names and growth stocks have seen their edge here become far less dominant. The gap between these cohorts is really just shrinking. Moving on to takeaway number two. What we learned from company commentary last week as we reviewed earnings calls. In a nutshell, the optimism that's been in place within the C-suite has been dented by uncertainty. This concept of uncertain optimism is something we've seen throughout reporting season and earnings calls, and that remained the case last week. But early on in reporting season, companies were more prone to dwell on the optimism, and last week it seemed like the pendulum swung a little bit more in the direction of uncertainty. Descriptions of the macro included fluid, cautious, uncertainty, sluggish, softer, challenging, and evolving. Specific issues cited included interest rates, inflation, trade policy, LA fires, weather, tough comps, the stronger dollar, currency volatility, and inventory challenges. At the same time, on the more positive side, companies also talked about optimism, confidence, a healthy job market, solid fundamentals, an improving ISM manufacturing index, and strong M&A pipelines. A number also referred to the idea of a better second half. On the consumer, we're not getting a lot of color yet, and we do expect to learn more here in coming weeks when we get more companies from this sector reporting. Last week, we saw old themes reiterated for the most part. Companies referred to the consumer as steady, value-seeking, resilient, and stabilizing, alongside caution on the lower end. High interest rates and mortgage rates were highlighted by a number of companies. One comment that stood out was that continuously hitting the consumer over the head with pricing is not winning. Another comment that stood out from a hotel company was that policy uncertainty may be causing consumers to be a little more tepid. Government policy was also in focus. Beyond tariffs and trade, issues discussed include a little bit on taxes, regulation, optimism, uncertainty regarding D.C. office market, federal end market spending uncertainty, the puts and takes and possible opportunities for DOGE, views on new leadership and health agencies, uncertainty from the freeze on foreign aid, and thoughts on immigration. One of the most colorful quotes we read last week came from an industrial company that compared navigating the current policy backdrop to riding Space Mountain at Disney World. Tariffs were obviously in focus. While a number of companies emphasized that the situation was still fluid and evolving, there was more of a willingness to provide specific numbers and to actually talk about Mexico and Canada instead of only China. And that's very different compared to what we saw early on in reporting season and last November's conference season when China was really the focus. Some companies are starting to bake tariffs into guidance, but others aren't. Some emphasized that their Mexico or Canadian exposure was low, and we came away with the impression that for a number of companies that were giving us specifics, China was more meaningful. Some companies with more significant exposure emphasized they would be passing on any new costs through pricing, and companies generally emphasized their planning efforts that are underway and their track records at managing through these kinds of situations. One auto company did note that a few weeks of tariffs would be manageable, but that more protracted tariffs would be highly problematic. And not surprisingly, companies throughout a number of different industries and sectors spent time walking investors through the headwinds experienced from a stronger U.S. dollar. Some companies are starting to bake further impacts into their guidance, and one company reminded analysts to update their models. Wrapping up with takeaway number 3. A quick update on post-election vibes, where the signals are mixed. Our earnings call transcript analysis tells us that corporate vibes have taken a hit, as we just noted. Meanwhile, investor vibes are weakening. Net bulls in the weekly AAII Retail Investor Sentiment Survey came in at minus 9.6% on the weekly unadjusted data point, and are now sitting in slightly negative territory, minus 1% on the 4-week average. While the weekly data point is now in excess of 1 standard deviation below the long-term average, we'd like to see a similar move in the 4-week average before contemplating the possibility that investors have gotten too pessimistic. Consumer vibes are also stalling. A weaker than expected reading for the University of Michigan Consumer Sentiment Index last week rattled stocks. That weak print echoes the weak reading from the Conference Board gauge for January, reported a week earlier. Last week's Michigan print was accompanied by a surge in near-term inflation expectations and was seen rather broadly across a number of cohorts, including income, gender, education, and partisanship. All that being said, the political vibes are still pretty strong. The president's net favorability has been improving and is back in positive territory. It's also been loosely aligned with trends in the S&P 500's performance, similar to the way polling data for the new president became correlated with U.S. equity market performance prior to the election. Views on the direction of the country and polling data have also moved up very sharply. This has occurred despite the pickup in policy uncertainty for things like economic policy, regulation, monetary policy, fiscal policy, taxes, trade, and healthcare. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.